Welcome back to 15 Minutes of Finance. This is the tax plan, where I help you keep more of your money. Today's topic is about retirement contributions, specifically analyzing the difference between traditional and what are referred to as Roth contributions to retirement accounts, such as 401k plans and IRAs. This is probably one of the single most fundamentally important tax topics you can understand in your life. There is not a listener out there that this does not apply to, and absolutely everyone can benefit from this if you do not very clearly understand these two concepts. So a lot of people know that you get a tax deduction if you contribute to your 401k plan or if you contribute to an IRA plan. Okay, so the difference is that a 401k plan is an employer-sponsored plan. So as an employee, you would be able to make deferred contributions to your 401k plan. There may or may not be a employer matching element where maybe your employer matches 50 cents to the dollar, matching your contributions up to a max of maybe 6% of your salary, something like that. And so then you also have money being contributed to your retirement account from your employer in addition from the amount that you've chosen to defer from your paycheck into that 401k plan. An IRA is just an individual retirement account, and that allows you to contribute money, just money that you have, not related to any specific source of income or job or employment or anything like that. You can open up an IRA account and start making contributions to an IRA account. There are significantly lower contribution limits for an IRA account. So that's one of the main kind of differences between a 401k plan and an IRA plan, other than the primary difference, which is that a 401k plan is from an employer. It's an employer-sponsored plan, where an IRA, an individual retirement account, can just be opened up by yourself as an individual. In both of these scenarios, the tax benefit is basically the same. Both of them reduce your income that you pay taxes on, okay? So let's break that down. So in a 401k plan, let's say you have a $50,000 salary. That normal gross pay amount is going to be in box 1 of your W-2, that first top left box to the right of your name and social security number and stuff like that on your W-2. Let's say you deferred $8,000 of that income into your 401k plan. That box 1 is now going to say $42,000. So you're not going to pay income tax on any of that money that you chose to defer into your 401k plan. And so we refer to accounts like traditional IRAs and 401k plans as tax-deferred investment vehicles. And what that means is you're deferring the taxes on that money. You didn't pay taxes when you contribute because you were able to get a deduction from your income in the year that you made the contribution. So you defer the tax until you take the money out in retirement. Okay, so that's what we mean by a tax-deferred retirement plan. And that's what a 401k is. That's what a traditional IRA is. So same thing with an IRA. I believe the limit in 2024 is up to $7,000 per person. And you have what's called a catch-up provision if you're a little older. So if you're over 50, I believe you can make an extra $1,000. So you can contribute up to $8,000. So if you have an IRA, a traditional IRA, you would just, you have some money sitting in your account. Up until the date of your tax return, you can contribute that, $6,000, whatever you want to contribute, up to the $7,000 max. And then you'll get an adjustment to your taxes. You'll get a deduction for contributions to a traditional IRA account. Okay, so a lot of similarities there. The main difference is one is employer-sponsored, one is just an individual account that you would open up. And the second major difference is the contribution limit. So a much lower $7,000 for 2024 for individuals, where in a 401k plan, you can defer up to a maximum of $23,000 into a 401k plan that maybe your employer matches a certain percent of. So much higher limits for a 401k plan. So you have a lot elevated ability to save into tax-deferred plans. So now let's talk about a Roth plan. So there are Roth IRAs. If you listen to any of our 2 cents segments on Wednesdays, you know that we constantly talk about, especially for young people, maximize money in a Roth IRA, maximize your contributions to a Roth IRA. So what is that? So a Roth IRA, the Roth treatment and any contributions to a Roth IRA are not tax deferred. So you get no deduction for contributions into a Roth IRA. Okay, so that's a bummer for a lot of people. People love looking for tax deductions. Okay, there's very few people that don't care how much they pay when I work with them each year as a CPA. Are there any other deductions? How else can I reduce taxes? Is there anything I'm missing? Is there anything else I can do to reduce taxes, right? So we like the tax deferred accounts, okay? Roth IRA is not one of them, okay? You put in what are referred to as after tax dollars because you're paying taxes on them. You've earned that money theoretically through some form of income. It could be a gift or whatever, but the money you're putting in is after taxes. You've already paid taxes on it. You get no deduction for it in the year you contribute it. So what's the benefit? When you retire and you're pulling money out of that Roth IRA account, you pay no taxes, okay? No taxes. Massive benefit, okay? So if you listen to some of our other episodes where we break down how easy is it really to become a millionaire, you remember learning if you're 20 years old and you're not going to retire till 65, you only need $12,500-ish based on traditional S&P 500 market rate of return, and you'll have $1 million in retirement, okay, based on compound interest and long-term growth over 45 years. So now we can really start to see the benefit of the Roth treatment, right? Okay, I can do a tax-deferred contribution to a traditional IRA when I'm, 19 and then 20, $6,000. Cool. I get maybe a couple $100 deduction based on my tax bracket. Maybe I save $1,000 if I have more income. And now when I retire and that money is $1 million, every time I pull out money, I'm paying regular income tax on withdrawals from a traditional IRA account. If I had done it, not gotten deduction, paid my full taxes when I was 19 and 20, and I put money into a Roth IRA account, when I retire, I don't pay any taxes on any of that income. So there is a massive incentive, specifically the younger you are, okay, to save money in a Roth IRA account, because this is sort of the analysis that you use to decide, is a Roth IRA worth it for me? Do you expect in your retirement to have more wealth and more income than you do now? You can quickly kind of figure out on your own logically here, the younger you are, the more likely you are to say yes to that question, right? If you're working part-time at Starbucks at 16 years old, do you expect that that's the peak? Hopefully not. No shame to people working at Starbucks in retirement, but obviously that's not what people project their maximum lifetime salary to be, right? They hope they retire with more money than that. So pay the taxes now and put it in a Roth IRA account so the money is entirely tax-free, okay? And keep in mind one more thing. You aren't paying regular taxes on retirement account income. And here's what I mean by that. If you have just an individual brokerage account, okay, it's not in any sort of retirement account, not a 401k, not a IRA. You just invested your own money. Remember that we've learned from some of these previous episodes, there are different taxes. For example, long-term capital gains are taxed at 0, 15, or 20%. The vast majority of taxpayers are going to be in a 0 or a 15% bracket based on those limits. There's things like treasuries that we've talked about in our 2 Gens 2 Cents episode, where if you put your money in U.S. treasuries and you earn interest, that interest income is not subject to state tax because it's a federal investment. It's not limited to any one state, so it's exempt from the state that you reside in and their tax rates. So there's all sorts of different ways that you can tax plan in your investments. If you're pulling money out in retirement from an IRA or a 401k or 457, whatever type of investment vehicle you have that's a retirement account, every dollar you pull out, it's just income. No, they don't care where that money came from. Once you're in a retirement account, the benefit of that is you can trade and you can make moves and you can get interest income and you can reinvest dividends and you can do whatever investment choices you want within that account as long as you're not pulling money out in retirement, and there's no tax consequences on any of that. So you can be a lot more aggressive in a retirement account. You might not want to make a trade with a lot of gain to invest in something else because then you'll have to recognize recognize capital gains, especially you make a really great trade in a short-term play in a company and it goes up 15% in 6 months. You say, that's awesome. I'm going to sell, get into something, more stable long-term. That was only a 6-month hold. So you would have to pay regular income tax, on short-term capital gains. You don't have to pay any of those taxes because it's in your retirement account. So what happens in your retirement account doesn't matter. It's not taxed any specific way, regardless of the type of vehicle that is in there. But when you pull money out in retirement, no matter where that money came from, whether it was original principal, interest, capital gains, dividends, whatever, it's regular income tax when withdrawn from your account. Okay, so you can't tax plan very, intensely the way you can with brokerage accounts where you can do all sorts of things. It's just income. Did you pull money out? Congrats. That's income. That's as simple as it is. So because there's no real flexibility here, you can see, that the Roth IRA account, you're not just saving on, capital gains or, federal only income taxes. Most of the time you're saving normal tax rates on that money, where it would be that withdrawal from your retirement account would be subject to ordinary federal tax, ordinary state tax. If it's in a Roth, it's completely tax-free federally. Okay, so massive incentive to invest money in a Roth IRA. Now, of course, this analysis means it's not for everybody. If you're in a really high-paying job and you've worked your whole career, you don't have a ton of money saved, but now you got this new promotion and you're making $280,000 a year, it might make sense to put in a traditional account, okay? Because maybe you're only going to work this job 5 years and then you're going to retire. You might retire with a lot less income coming in month to month than you were making when you were making almost $300,000 a year. So there are people where it is straight up better to invest in a traditional account, get the tax deferred treatment, and save on taxes now. But anybody young, most people, I would say under 40, if you're planning on retiring at a normal retirement age, talk to your advisor on the situation that works best for you, but playing averages here, anybody under 45 to 40 for sure, they're much more likely to benefit from a Roth contribution to a retirement account than they are to invest in a traditional account. Okay, so the last thing I want to talk about here is, because we talked about 401ks at the beginning, what a lot of people don't know is that 401ks often have Roth treatment of contributions. So the money that your employer matches, or maybe you're self-employed and you set up a solo 401k or a 401k for your own company, the deductions from the company's perspective, they always have to be traditional because the company is getting a deduction for the money brought in. So you can't get a tax deduction when you contribute and then also get tax-free income in retirement. You always choose between the two. So you don't get a deduction for your Roth contributions, but you can't choose for your company's employer matching contributions to be tax-free Roth because they're getting a deduction for it, so you can't then get an extra deduction of tax-free income. So always check. If you're under 40 or 45, if you have a 401k plan, first of all, make sure you're maximizing the match. Always maximize free money. Contribute as much as you can. Our motto here, invest early, invest often, nothing replaces time. And then 3, see if you can make Roth contributions to your 401k plan rather than just traditional contributions, because boy, is your retired self going to thank your young self for making that choice when you have over $1 million and you're pulling money out and you don't worry about taxes for the rest of your life. Your Social Security is under the limit. You don't pay any taxes on that. The vast majority of your investments are in that Roth IRA or Roth 401k account, and you can use as much money as you want, take as little money as you want. You don't pay taxes for the rest of your life after you retire. That's a massive thing. And remember, I think there is really a disconnect in investors. It is so hard to get young people to invest. So I'm going to talk about this number in probably every other episode. When I talk about you might have $1 million tax-free, there's a lot of people I know that are listening to this and they're thinking, I'm not going to have $1 million when I retire in a Roth IRA. What are you talking about? Remember, if you're 20 years old, it takes $12,500 to retire with $1 million. It does not take a lot of money if you're diligent young. So send this episode to a young person. I think there is a massive disconnect in the younger generation, not really believing they're going to be rich, not believing they're going to retire millionaires. If you start young, it is incredibly easy to be a millionaire with a good advisor and discipline young in your budgeting, putting money. Look, you get your first job when you're 16. you put $2,000 each year into a Roth IRA, just $2,000, before you're 25, you can stop contributing to retirement and you'll have over $1 million if you do that when you're 16. Okay, so it's achievable if you're diligent young. Okay, and if you're not young, we have lots of episodes for you too. How to maximize, are you ready for retirement? How to maximize your tax situation in retirement. So all hope isn't lost for you if you're retired or you're getting close to retirement, but specifically for young people, there is nothing more powerful than millions of dollars tax-free when you retire and no stress in your life because you were diligent young and you put just a little bit of money every year consistently. You invested early and you invested often, and now you're a millionaire tax-free in retirement, okay? Hugely powerful tool to maximize contributions to Roth accounts, whether that's a Roth 401k or a Roth IRA, okay? So there's one kind of thing that I want to talk about real quick in this episode, and I try to keep an eye out for, I'll call it bad advice that I see in pop culture. And when we have an official studio, which we're currently looking for, and we start doing a lot more video content, I will attempt to learn the skills required to maybe include some clips that I can kind of respond to and analyze. But a lot of people I know in today's day and age are watching Love is Blind, okay? So if you're like me and my wife, you're watching Love is Blind. It's bingeable, okay? It's trash reality TV, but it's really fun to watch. So if anybody of you have seen this show, there's a couple right now, and Hannah on that show is explaining investments, and she's very frustrated with the person she's engaged to. I believe that's Nick, unless I'm getting my names mixed up. But they're talking about investments, and she's frustrated that he doesn't know anything about money. So she's explaining investing in stocks to him. And what she tells him is, look, you don't have to be super risky with your investments, okay? I believe she's 26 on the show, so she's very young. She says, look, I work a job. You can have high risk, high reward, or low risk, low reward. I can't afford to take that risk, so I'm in a low risk, low reward. You don't have to take a big risk. Just make sure you're earning money, okay? Props to her. Investing early, investing often, a 26-year-old passionate about investing in their 401k. That's awesome. It's really bad advice, okay? So remember, we've talked about risk over the long term, okay? If you've listened to our 2 Gents episodes, if you've listened to James and his 15 Minutes of Finance episodes, we've really tried to hammer in recovery from recession is quick and consistent. There have been a handful in the history of our country recessions that have not rebounded within 18 months. They're, I believe, all rebounded within a couple years, okay? You're 26. You should absolutely be in high risk, high reward, okay? This isn't specific advice to your situation. Talk to your advisor. If you don't have an advisor in your 401k plan, see if it can be managed by an advisor or see if there are other choices within your fund options. If you're 26 years old, of course you can afford to be high risk, high reward. If there's a recession tomorrow, do you know what you should be in? Growth stocks. Because you don't need the money for 30 years, 35 years. If you're going to retire at 65, 63, you can absolutely afford the up and downs of the market, because not only is the market overall trending up, which means the recession 20 years from now might still be higher than the market is at a high today, but also you have so long to let your money grow. You shouldn't all be in conservative, the end of target date funds, having a lot of bonds and treasuries and fixed income securities. The market's 10.26%. If you're not at least riding the market highs and lows, you are really missing out on, we're talking about hundreds of thousands of dollars of difference if you're conservative in your early and mid 20s and you're getting 4 or 5% because you don't want to risk when you could be earning a traditional rate of 10.26%, which is what the market does. You might earn higher than that long term in a growth fund if you can afford for 30, 35 years for that money to grow. Okay, so there's a little bit of pop culture analysis for you guys. Love the investing early, love the investing often. If you're 25, 26, and you can be that passionate about investing, talking to your partner and your fiance about how to maximize their stocks, awesome, you're ahead of the curve. But don't be scared of the highs and lows of the market, especially if at a young age, you're maximizing money into a Roth account, and then you want to grow that money as much as you can. Don't be stupid with it. Don't put all your money in one stock. Don't put all your money in cryptocurrency if you don't understand it, but you should be willing to accept some risks, some highs and lows, and then you can retire with a lot of money and you can owe no taxes on it for the rest of your life in retirement. Thank you for listening to another episode of 15 Minutes of Finance, the tax plan segment. I hope you learned something about these different types of retirement accounts, how to choose the right account for you, and how powerful the tools of a Roth IRA can be for your long-term wealth plan. As always, please respond to the episode, if you're on Spotify or whatever, with any comments or questions you'd like me to answer or topics you'd like to hear in the future. If not, we'll see you next time. Invest early, invest often. Have a good week.